Welcome back. We are continuing our discussion for adjusting journal entries made at the end of a period, and we have so far finished our accrual adjusting entries. We spoke about accrued revenues and accrued expenses, and we discussed how those are situations where the cash comes after either the revenue is earned or the expenses incurred. That would be an accrual situation. We're going to move now to our other broad category of adjusting entries, and that's deferrals. So as a reminder, our deferrals occur when the cash comes before the revenue is earned or the cash is paid before the expenses incurred. Remember our before. Remember deferrals DEF. The EF you can think of in deferrals as the EF in before. I know it's kind of a far stretch, but that's really the best I could come up with. If anybody has a better idea to try to remember the two, I would appreciate you letting me know so I can use something different. So let's get started. This screencast will cover our discussion on unearned revenues. Unearned revenues are in fact deferred revenues. So in this situation, it's going to be where a customer pays you money before you have provided the service or before you have delivered the good. So let's take a look at an example. On March 1st, Storage Co. rents out a unit and receives $900 for the first 3 months' rent. The company has a year end of April 30th. So what's the adjustment Storage Co. must make on April 30th? So start asking yourself when you see these problems, is this a deferral or an accrual type of adjusting entry? Well, we know it pertains to revenue because money is coming in to us or into Storage Co. We also know that the money is coming first. The money is coming before we've earned the revenue. So if the money comes before, we're dealing with a deferral. Deferred revenues are known as unearned revenues. There's two ways we can enter this situation into our books. Let's look at one of them first. The first way is to record the prepayment as unearned revenue. I am going to use probably quite often through this workbook our T accounts. I think it helps a great deal, especially now that we're discussing deferrals, and you'll see why. So let's use the T account. We'll make a T account for unearned revenue. The problem tells us that we received $900 on March 1st, and that's to cover rent for 3 months. So the rent will cover all of March, all of April, and all of May. So on March 1st, we are going to record an entry. This is not the adjusting entry. This is just capturing the event of the cash receipt. So on March 1st, during the period, we are going to debit cash, because we received cash, for $900. Let me make those a little bigger so you can see them. Okay, and we're going to credit our liability, unearned revenue. Okay, we know this is not cash. We know this is not an adjusting entry, rather, because it includes cash. And plus, we are not making any adjustments. We're just recording the receipt of cash. So our cash was debited to show the increase in our cash, which is an asset. And our liability, which is unearned revenue, was credited to show an increase in that. So on March 1st, that's the entry you make. Well, now it's the end of the year. I added this little timeline down here. I put you guys on pause for a second so I could do that. So now at the end of the year, what happens? Or at the end of the period, really, what happens? That's the time when we have to, as accountants and bookkeepers, consider what sort of adjustments do we need to make. So what's happening in this situation? Well, let's say that's March 31st, let's assume, on our timeline. My fonts are a little off. But remember, this is a 3-month, that's weird, right? Let me make them even so that that's not a distraction. So on on March 1st, we received the $900 cash, and that is to cover 3 months worth of rental time. So here's 1 month, here's the 2nd month, and here's your 3rd month. So remember, the problem says our year end is April 30th. That's right here, right? So by that time, and we'll highlight that. Let me move this a little bit. By that time, okay, 2 months, all of March and all of April, have been spent in that office space or whatever the space is that they're renting. So we have incurred, or the tenant has incurred that expense. We have in fact earned the revenue for that time period. So our adjusting entry at April 30th is going to be to lower our unearned revenue. How much? Well, if we earned $900, or if we are charging $900 for 3 months, and 2 of the 3 months have gone by, how much is that? That is $300 a month times the 2 months that have passed, so $600. We're going to debit unearned revenue for $600. And then what do we credit? What's our credit? Well, we know we don't use cash in an adjusting entry, and it wouldn't make sense to use cash. And we also know we have already used one balance sheet account. That's the liability of unearned revenue. So if we have one balance sheet account, we know we need one income statement account. Those 2 months have passed. The tenant has spent time in that space that they are renting. We have now earned the money that they prepaid us in advance. 2/3 of that money we've earned. So we can call it rent revenue in the amount of $600. Okay, let me just format this a little so it looks nice and even. I'm going to move this over as well so everything lines up. Okay. That's your adjusting entry. Once we post this, now let's go back to our unearned revenue T account. So on March 1st, let's add another column here. On March 1st, we had posted the $900 when it happened, right? On March 1st. Okay. Then on April 30th, we booked the adjusting entry and we debited unearned revenue $600. So what is my balance now? Let's draw a line here. What is my balance, if you guys remember, from in unearned revenue? Well, a $900 credit and a $600 debit nets me a $300 credit balance. And that's at the end of their fiscal period, April 30th. So what have we accomplished here? Well, there was a timing difference. The cash came before we earned the revenue, so we know there's going to be a need to make an adjusting entry at the end of the period. So our adjustment tells us that during the time from the point we received the cash to the end of our fiscal period, we did in fact earn some of that money, and we're capturing it right here on this April 30th entry. Okay. So like we discussed with accruals, it's really important to know that for deferred revenue, what we are doing when we book our adjustment is decreasing the liability of unearned revenue. Okay. And over here, our credit to rent revenue, we're increasing our revenue account. So without doing this adjusting entry, we are going to be overstating our liabilities. Without this decrease here, the debit to unearned revenue, at the end of the day, when we process our financial statements, we will be overstating our liabilities. Unearned revenue will still be at $900. Likewise, if we don't capture this rent revenue with this credit, then we will be understating our revenue and thereby understating our net income. All right, I'm going to end this screencast right here, but there will be, the next screencast will be a continuation of this same problem. So look for Mastering Adjusting Entries, screencast 4.2. See you in a second.